They were never meant to be places that profited off pain. They were supposed to be trusted guardians, protectors of the hard-earned money of people fighting for a better life. But what if I told you that across Africa, these very institutions have become something else entirely? What if the system designed to lift millions out of poverty has instead become one of the most effective weapons ever created to keep them there? In 2024, the African banking industry was valued at a staggering $100 billion. But these numbers aren't just celebrating business success. They tell a much darker story. They are not profit margins, they are body counts. Banking wasn't born in steel and glass. It began with clay tablets and temples. As early as 2000 BCE in Mesopotamia, priests in cities like Harak and Babylon acted as the world's first bankers. They stored grain, issued loans, and kept meticulous record etched in clay. By the time of Greeks and Romans, banking had evolved. In the bustling marketplace of Rome and Alexandria, moneylenders exchanged currency, funded trade, and offered credit. After Rome's fall, formal bankings collapsed for centuries. But in the Middle Ages, it resurfaced through merchants, money changers. In Renaissance Italy, families like the Medici pioneered modern finance, developing double-entry bookkeeping and opening branches across cities. The Bank of England, founded in 1694, marked a turning point, issuing banknotes and managing government debts. The Industrial Revolution brought a rapid expansion: banks, finance factories, railroads, and global trade. But what no one was ready for is that this once humble institution, born from necessity, would become a double-edged sword, one that will drive millions into poverty, bankruptcy, crime, and even death. When a system designed to serve becomes a system designed to starve, we need to ask, who's holding the knife? And you watching this right now, you might think this does not affect you, that these are just distant stories from another continent. But the mechanics of betrayal are universal. What's happening in Africa is happening everywhere, just with different faces, different banks, different degrees of desperation. This is the story of how banking system became weaponized against the very people it was meant to serve. You know, growing up, I remember my grandfather's friend telling me how proud he was when he opened his first bank account. The reverence in his voice when he spoke about it, like he'd finally been accepted into society's inner circle. I wonder what he'd say now if he could see what the system has become. July 1896, Mombasa, Kenya, the National Bank of India plants its flag in East Africa. This is not just another business opening, it's an extension of an empire. For the first time, African wealth can be systematically extracted through official banking channels directly to London. What's the first thing you need to control a nation? It's money supply. Whoever prints the cash sets the rules. And in 1890s, East Africa, that meant London calling and Africans paying. By 1919, the London-based East African Currency Board was established. Every shilling had to be backed by sterling. No backtalk from locals. This wasn't just economic policy. It was colonial mind control, priming decades of dependency. And here's the twist most history books won't tell you. These banks pointedly serve only Europeans and Asian clans, excluding native Africans entirely. Can you imagine being banned from a bank because of your skin color? Being forced to store your savings in a box under your bed? Vulnerable to theft, fire, and decay. The message was clear. Finance was for the colonizers, not the colonized. They didn't just steal the land, they monopolized the mechanisms that give money meaning. That legacy of exclusion runs deeper than most realize. Because when we fast forward to today, the names and faces have changed. But has the system itself? Or has it simply swapped colonial masters for homegrown ones? June 1963, after a decade of colonial rule, Kenya gains independence. The nation erupts in celebration, but the banking system remains in foreign hands. 2 years later, something revolutionary happens. The Cooperative Bank of Kenya is born, the first fully locally owned commercial bank in Kenyan history. This was not just a bank for the elite. It was owned by cooperatives, farmers, traders, and credit unions, ordinary Kenyans pooling resources to create a financial power. By September 1966, President Jomo Kenyatta inaugurates the Central Bank of Kenya, wresting control of currency and monetary policy from colonial hands. For the first time, Kenya could control its own money supply. But here's what they didn't tell you. At independence, colonial coffers held by currency board were largely invested overseas, effectively stunting local liquidity. The biggest move came in November 1970 when the Kenya Commercial Bank was born from the government's takeover of the British-owned National and Grindless Bank. With the bold Swahili slogan, "Nchi hii ni nchi yako, banki hii ni banki yako. This is your country, this is your bank." KCB promised to serve ordinary Kenyans who had long been rejected. Thousands rushed to open accounts, injecting their life savings into the formal system. Finally, the people had access. They were sold freedom, but handed a different kind of chain, one made of account numbers and loan terms instead of iron. But here's the dark irony that no one saw coming. Banks meant to serve people would just easily be weaponized against them. And now, these weapons were in new hands, not colonial masters, but homegrown elites. Instead of colonial exclusion, a new form of betrayal was brewing: political capture. The stage was set for the next chapter of financial weaponization. Washington, D.C., in the marble halls of the World Bank and IMF, a new form of financial control is being engineered. Kenya, under President Daniel Arap Moi, becomes one of the first countries to sign a World Bank structural adjustment loan, receiving $55 million in credit. But this wasn't free money. The fine print was brutal. Devalue a currency, cut government spending, privatize industries, remove subsidies. For ordinary Kenyans, the effects were immediate and devastating. The shilling plummeted. Prices for basic commodities soared. Public services crumbled. Hospitals ran out of medicine. Schools became overcrowded, losing resources. Yet somehow the political elite seemed untouched by these necessary sacrifices. If a foreign institution can dictate your country's entire economic policy, who really runs your economy? While loans flowed in, wealth flowed out, and Africa lost $50 billion every year to illicit financial flows. Amid this chaos, a small revolution was happening in the foothills of Mount Kenya. In 1984, the Equity Building Society was established in Murang'a. Founder Peter Munga and accountant James Mwangi had a radical vision: provide financial services to ordinary Kenyans whom big banks had ignored. This village bank offered tiny loans and savings accounts to poor farmers. It was dismissed as insignificant, just as many of you watching might feel your financial struggles are insignificant in the grand scheme. By 1993, Equity was technically insolvent. This small experiment in banking for the people was on the verge of collapse, but James Mwangi refused to let it die. Through sheer determination, he orchestrated a turnaround that would later reshape African banking. Meanwhile, as the 80s turned to the 90s, the IMF's structural adjustments were creating the perfect environment for something more sinister, a scandal so massive it will shake Kenya to its core. November 1990, Nairobi, Kenya. As economic desperation looms, Finance Minister George Saitoti approves a secret arrangement. A company called Goldenberg International, led by a young trader named Kamlesh Patni, is granted a monopoly to export gold and diamonds. The incentive, an extraordinary 35% subsidy on export earnings, far above the standard rate, paid in shillings for bringing in hard currency. There was just one problem: Kenya produces virtually no gold. What followed was breathtaking in its audacity. Goldenberg claimed massive payouts from central bank for gold and jewels exported that existed only on paper. To launder the illicit gains, Patni was allowed to establish his own bank, Exchange Bank, becoming both the thief and the getaway driver. By November 1991, Kenya's foreign aid donors had seen enough. Citing rampant corruption, they suspended $350 million in aid. Cut off from legitimate funds, the government resorted to disparate measures, printing money and accelerating the Goldenberg fraud. In early 1993, the scheme began to unravel when whistleblower David Munyakei, a low-level central bank clerk, leaked documents to opposition MP Paul Mwishe. The scandal exploded across newspapers. Investigations revealed Goldenberg had siphoned an estimated 158 billion Kenya shillings, roughly 10% of Kenya's GDP. This was not just theft, it was financial terrorism. They did not need guns to rob the nation, they just needed paperwork. The Kenyan shilling collapsed, plunging from about 30 Kenyan shillings for 1 USD in 1990 to 70 Kenyan shillings for 1 USD in 1993. inflation soared above 50%. With central bank reserves plundered, banks started collapsing. A wave of 19 bank failures from 1993 to 1995 wiped out many indigenous banks. Thousands of depositors lost their life savings overnight. Lives were shattered, dreams evaporated. While the architects of this fraud built mansions and bought luxury cars, ordinary Kenyans paid the ultimate price. And what about our whistleblower, David Munyakei? For his courage, he was fired, blacklisted, and died in poverty in 2006. The ultimate betrayal, punished for doing what was right. By August 1997, the IMF had had enough. It suspended Kenya's enhanced structural adjustment facility and froze all lending. The 1990s became Kenya's lost decade, a period when the financial system was weaponized not by foreign powers but by Kenya's own elite against its people. But if you thought the Golden Bag scandal was the worst that Kenya had seen, wait till you meet Fuliza. Because modern banking didn't just copy the betrayal, it made it scalable. August 7, 2006, crowds gather at the Nairobi Stock Exchange as Equity Bank lists its shares for trading for the first time. It's a fairy tale turnaround. Just a decade earlier, Equity was young, dumb, and broke, and laughed off by the big banks. Now CEO James Mwangi presides over the largest customer base in Kenya. Equity had flipped the script on banking norms, focusing on micro-savers and small borrowers, people the big banks wouldn't touch. Global investors took note. In 2007, Helios invested $185 million in Equity, buying a 24% stake. For ordinary Kenyans, Equity's rise was empowering. It popularized accessible services and brought millions into the formal financial system. This success forced competitors like KCB and Coop Bank to also downscale and cater to retail customers. A revolution seemed underway. But by the mid-2010s, a darker reality emerged. Kenyan banks were posting record profits while charging interest rates as high as 24% on loans. The question became unavoidable. Were the banks finally serving the people, or had it simply found more sophisticated ways to extract wealth? They were not banking the unbanked, they were harvesting them. 24th August 2016, President Uhuru Kenyatta stuns the financial industry by signing into law Banking Amendment Act, capping commercial lending rates at 4% above the central bank rate. Kenyans celebrated after years of being charged 18% plus interest while banks enjoyed fat margins. This seemed like justice, but the unforeseen consequences was brutal. Banks froze lending to riskier borrowers. An estimated 1 million small borrowers were cut off from credit. Instead of lending to the people, banks shifted their money to government treasury bills, safe, profitable, and risk-free. By 2019, under pressure from the IMF, Kenya repealed the cap. Think about this for a second. A sovereign nation tried to protect its citizens from predatory interest rates. The international financial institutions effectively forced them to stop. The battle over how the financial system should serve the public or private profit remains fierce. In many parts of Africa, smartphones have revolutionized banking. Services like M-Pesa in Kenya allow people to send money with a simple text message. January 7, 2019, Safaricom, Kenya's leading telecom, launches Fuliza, an innovative mobile money overdraft service in partnership with KCB Group and Commercial Bank of Africa. The response is explosive. 1 million users sign up in the first 8 days, drawing over $10 million in short-term loans. For millions of Kenyans living paycheck to paycheck, Fuliza seemed like a miracle. Instant cash for school fees, food, medical emergencies. I remember talking to a woman in Kibra. She told me how digital loans helped her start a small vegetable stand. 6 months later, I found her again. The stand was gone. The loans had spiraled, the interest had compounded, and now she was in deeper poverty than before. That's when it hit me. This is not just a bug in the system, it's a feature. But here's what a few Kenyans realized. Commercial Bank of Africa was nearly 25% owned by the family of President Uhuru Kenyatta. The lifeline for daily cash was underwritten by their president's own bank, and the cost, while not advertised as loans, the fees on these overdrafts translated to effective annual interest rates exceeding 365%. Take Dennis Monyanze, In February 2024, he borrowed 20,000 Kenya shillings, about $250 from a digital lender called Canva Trading Kenya Limited. He wanted a motorbike for work, deliveries that would help support his family, not a luxury but a livelihood. But the 20% monthly interest rate was relentless. Every shilling he earned melted into repayments, nothing left for his kids, nothing for the table. He rode harder, longer. The sun burned his leather jacket. The roads wore him down, but the debt grew faster than he could run. It is the perfect crime. The victim walks into the trap willingly, signs the confession, and pays for the handcuffs. That motorbike, his ticket to freedom, became a shackle. Every shilling he earned melted into repayments. November 30th, 2022, in a direct challenge to predatory lenders, newly elected President William Ruto launches the Hustler Fund, a state-backed small loans program. With great fanfare, Ruto describes the 50 billion shillings fund as a tool to empower 15 million hustlers, with loans at only 8% annual interest. In its first weeks, millions sign up, underscoring the vast unmet credit need. Established banks watched as the government muscled into the lending business they long dominated. The digital loan revolution promised financial inclusion, but instead it created digital debt traps that enslaved millions, weaponizing the very technology that was supposed to liberate them. This was not just a trap, it was designed by the president himself. The Hustler Fund was only the beginning. In the heart of Africa, where hope battles hardship daily, millions turn to banks not for dreams of wealth, but for the quiet dignity of survival. A mother borrows to mend a leaking roof. A father signs a loan to pay school fees. A young entrepreneur risks everything for a modest machine to grow her small business. These are not reckless dreamers. They are ordinary people asking for nothing more than a fair shot at life. Consider the case of Mzee Eric Mushina Kimani, who offered 12 million shillings property as a security for a loan to a businessman in 2014. What he didn't know was that his trust would be betrayed in the most devastating way. Months later, he discovered his property had been used to secure loans from years before without his knowledge. The amount he was to pay back was not the original loan. It had mysteriously ballooned to 53 million shillings. In 2018, the bank issued a notice to sell his property. His 40 million home was now at risk because of hidden charges and inflated debts. The bank had even failed to follow legal procedures, sending the auction notice without the required 40-day notice period. They don't just take your money, they take the roof over your head and call it business. In 2012, Mr. David Gitome found himself battling Equity Bank over 5.5 million shilling loan secured by his Nairobi property valued at 43.2 million Kenya shillings. When Equity Bank attempted to auction the property without adhering to the new legal standards required by the Land Act of 2012, Mr. Gitome had to fight for his rights in court. Let that sink in. A 6 million loan, including interest, threatened to raise a 43.2 million property. A life's work, gone because of predatory lending practices. And it's not just individuals, even corporations face the banking system's betrayal. In 2023, Guarantee Trust Bank seized a high-value asset from Stallion Nigeria Limited over a 13 billion naira judgment debt, one of the largest asset-enforced cases in recent Nigerian financial history. Among the repossessed properties were showrooms housing luxury automobiles, including premier brands like Audi and Bentley. In Uganda, Pinzika Enterprise, a major player in the poultry feed production, battled Cairo International Bank and DFCU Bank over 20 billion shillings in debt, leading to attempted auctions of its properties. Only a last-minute court intervention saved the company from collapse. The pattern is clear. Loans are designed not as ladders to prosperity, but as traps to transfer assets from borrowers to banks. The system is not broken. It is built to break you. Imagine this, you're a young student far from home, chasing a dream across the oceans. The United Kingdom stretches out before you, cold, vast, unrelenting. For Bamidele Dayo, a Nigerian student in the UK, his United Bank of Africa UBA account was his lifeline, a connection to his family, to security, to survival. His UBA account held over 2.27 million naira, his entire life savings, enough to cover rent, tuition, and living expenses. It started with a simple transfer of 10,000 naira. Bamidele logged in, entered the details, and hit send. The kind of transaction we all do without thinking. But then his phone buzzed, a debit alert he hadn't authorized, then another and another. Like vultures circling, the alerts kept coming. 50,000 naira gone, 200,000 naira gone, then more. In mere minutes, his entire life savings vanished into the void. He called UBS customer service, hands trembling, voice cracking. The line cracked with static, and a bored voice promised to look into it. Hours bled into days, days into weeks. The bank's response, or lack of it, cut deeper than the loss itself. When your money vanishes, so does the bank. Funny how that works. They launched an investigation, a word tossed around like a lifeline. But it was a sham. No updates, no apologies, just vague emails and automated replies. In South Africa, a retired nurse named Kenyans faced a similar betrayal. After decades of dedicated service, a pension of 2.6 million rand was meant to provide financial security for her family. On her boyfriend's insistence, she opened an account with FNB rather than Absa, a preferred bank. Soon after her pension was deposited, 2 million rands vanished without her knowledge or presence. FNB promised a private investigator. The police case went nowhere. Her boyfriend disappeared. I have nothing to feed the children, she said. Her two sons, once hopeful for university education, were now forced to drop out. Now they resorted to smoking in despair. In Nairobi's Gikomba market, Mario Nyambura Karanja, a hard-working trader, lost over 700,000 Kenya shillings from her Equity Bank account overnight. No alerts, no flag transactions, just silence. Her entire financial foundation collapsed beneath her feet. Despite raising the alarm, Equity's bank response was lukewarm at best. No decisive action, no refund, no accountability. Only after groundswell of public outcry and relentless online pressure was Marion's money returned. Not because the system worked, but because she refused to be silent. For South African entrepreneur Penny Ho, it was a suspicious debit of 109 rands from their Standard Bank business account labeled Synergy 11024U. It wasn't the first time. The same unauthorized debit had hit less than a year earlier, a revealing pattern of small but systematic theft. It's the greatest magic trick in finance. Your money vanishes in plain sight. And when you demand answers, so does the magician. Adding insult to injury, Standard Bank might charge them a fee to just revert the fraudulent transaction, a penalty for being defrauded. These are not isolated incidents. They are symptoms of a system where your money's safety depends not only on the regulations or ethics, but on how loudly you can complain when it's taken. The banks that can track your spending habits down to the last cent somehow fail to notice when your life savings vanish in minutes. Is it incompetence or by design? When these thefts happen once, it's a tragedy. When they happen repeatedly, it's a strategy. March 2025, Absa Bank in South Africa is hit with a $550,000 fine for failing to flag suspicious transactions. That fine, barely a rounding error for the bank of their size, sends a chilling message. Dirty money flows with minimal consequences. Meanwhile, Lonasta Cell, MTN in Liberia, pays $125,000 for letting the mobile money platform a playground for shady deals. Those very transactions could have funded terrorism or organized crime, hurting communities already living on the edge. In Mozambique, banks helped facilitate a $2 billion scandal meant for a fishing project, only for that money to be stolen by corrupt insiders. The money did not buy fishing boats. It bought weapons, fueling conflicts that destroyed countless lives. Africa loses 50 billion every year to illicit financial flows, money that could build schools, hospitals, and infrastructure. When banks launder dirty money, they wash away futures with it. But the rot goes deeper than the money laundering. Some banks aren't just looking the other way. They're actively funding projects and regimes that destroy lives. In Angola, banks like Banco de Pupanca e Credito have borrowed money into Sonangol, the state oil giant responsible for corruption that keeps millions in poverty. Billions flow into offshore accounts while over half the population lives without access to basic healthcare. In Nigeria, Zenith Bank has financed oil companies in the Niger Delta, a region devastated by oil spills that have poisoned water for over 30 million people. Families in the Niger Delta are forced to live in a toxic wasteland where clean water is a distant dream and disease runs rampant. How many children have died from preventable illnesses? How many families have been torn apart by the pollution? Yet, the loans keep flowing, the banks keep profiting off the suffering. And in South Africa, banks like Standard Bank have been complicit in exporting arms to South Sudan, where civil war has torn apart lives of over 400,000 people. The money that should have gone into rebuilding lives instead fuels bloodshed in war with no end in sight. You might ask yourself, how can financial institutions sworn to protect and grow wealth become so intimately involved with its destruction? The answer is simpler than you think: profit above all else. When the bottom line is the only line that matters, human suffering becomes an externality, a cost that doesn't appear on the balance sheet. We've seen how banks can fail their customers, but what if their threat comes from inside the vault? July 10th, 2024, Equity Bank, Kenya's largest bank by customers, is rocked by 1.5 billion internal fraud, a heist that reads like a Hollywood script. The money earmarked for clients' salaries vanishes through a series of illicit electronic transfers. 47 separate withdrawals were made from Equity's corporate salary account and funneled into fake accounts. The thief used login credentials of a manager who was on leave. The bank's own systems turned against it by insiders. In a bizarre twist, the implicated manager David Mashiri Kimani and his 69-year-old father were abducted by armed men in coordinated kidnappings. Portions of the stolen funds were swiftly converted into cryptocurrency and funneled through other banks to obscure their trail. Kenya's Directorate of Criminal Investigations launched a massive probe, eventually arresting over a dozen suspects, including a Nairobi lawyer accused of masterminding the laundering of the loot across 52 accounts. The scandal forced Equity Bank CEO James Mwangi to overhaul the bank's internal controls and reportedly led to the management changes in its IT and risk departments. When banks can't keep its own money safe, your savings are just collateral damage waiting to happen. But the question remains, if a bank can't protect itself from theft, how can it protect you? If it can be weaponized from within, what chance do ordinary customers have? October 1st, 2019, in Nairobi's finance circles, a big announcement is made. NIC Bank and the Commercial Bank of Africa, CBA, have completed a merger to form NCBA Bank, now Kenya's third largest bank. This was not just business, it was deeply political. CBA was largely owned by the family of Kenya's President Uhuru Kenyatta and NIC Bank by the family of longtime central bank chief Philip Ndegwa. In a surprise to many, the deal was structured as a reverse takeover, with the president's family controlling a major bank. NCBA became a significant buyer of government securities, raising questions about conflicts of interest. 4 months later, another symbolic change. Barclays Bank Kenya, which had operated in the country for over a century, officially rebranded to Absa. Barclays first set up shop in Kenya in 1916 during the World War I, and for decades it was nicknamed Banki ya Mzungu, White Man's Bank, due to its focus on European settlers. The banks may change names, the logos may change colors, but the music never stops for those at the top, only for those forced to stand when the melody ends. The rebranding marked the end of an era of direct colonial legacy in Kenyan banking, the last of the big British banks giving away to an African-owned entity. Across Africa, bank consolidation has accelerated. Fewer larger banks are now controlling more of the continent's deposits and loans. This concentration of financial power raises a troubling question. If banking was once weaponized by colonial powers against Africans and later by political elites against citizens, what happens when that power concentrates in even fewer hands? The faces have changed, the names on the buildings are different, but has the system itself evolved or merely adapted its method of control? The digital revolution promised to democratize finance. With a simple feature phone, millions of unbanked Africans could suddenly send money, pay bills, and even access loans. Services like M-Pesa in Kenya processes billions of dollars annually, reaching people traditional banks never could. But there's a hidden cost to this convenience: data. Every transaction, every purchase, every loan application creates a digital profile, more detailed than anything colonial banks ever processed. This data becomes a weapon in the hands of predatory lenders who use algorithms to target the vulnerable with loans they know many will not be able to repay. Interest rates and fees are often hidden in complex terms and conditions, deliberately hidden from users with limited financial literacy. In September 2022, under public pressure, Safaricom and its partner banks NCBA and KCB announced a major cut to Fuliza overdraft fees. Daily charges on small loans were slashed by 50% and a 3-day grace period was introduced for repayments. This timing was not coincidental. President William Ruto's administration was about to launch its own Hustler Fund to compete with private digital lenders, a state-backed small loans program aimed at liberating millions from the predatory lenders. At just 8% annual interest compared to the hundreds of percent charged by some digital lenders, a digital attempt to weaponize finance for the people instead of against them. Digital banking is not inclusion, it's surveillance with a transaction fee. Digital finance in Africa stands at a crossroads. It could liberate millions from financial exclusion, or it could become the most sophisticated system of extraction yet devised. Colonial banking reimagined for the smartphone era. In the face of these betrayals, where can ordinary people turn? Regulatory bodies often move slowly, if at all. There are occasional victories. In September 2018, the Central Bank of Kenya fined 5 major banks a total of 392.5 million Kenya shillings for aiding corruption via unreported transactions. This led banks to invest more in compliance and anti-money laundering systems. But meaningful change often comes not from regulators but from public pressure. When Marion Nyambura Karanja lost 700,000 shillings from her Equity Bank account, it was relentless online pressure that finally forced the bank to return her money. Across Africa, courts have become battlegrounds where individuals fight against financial injustice. Laws like Kenya's Land Act of 2012 introduced stricter procedures for banks when recovering debts through asset sales. And in parliament, debates range about how to balance financial innovation with consumer protection. Global standards for banking transparency and consumer protections are slowly being adopted across the continent. And perhaps most crucially, financial literacy initiatives are empowering ordinary Africans to understand the systems that for too long have been weaponized against them. Knowledge is not just power, it's armor against financial predators. But the fight is far from over. The system is deeply entrenched, and those who benefit from it resist change at every turn. These stories we have explored raise profound questions about the role of finance in society. Is a bank merely a business with no obligation beyond profit, or does it have moral duty to the society in which it operates? The colonial banks that once excluded native Africans have given way for African-owned institutions, but has the fundamental relationship changed? Banks market themselves as partners in prosperity, yet their action often sabotage the very prosperity they claim to support. The average African bank CEO makes more in a month than most customers will ever see in their lifetime. This is not just inequality, it's a system designed to extract rather than empower. When banks are defrauded, they spare no expense in pursuing justice. When customers are defrauded, they often face indifference or outright stonewalling. Ask Bamidele, Kenyelwe, or Marion whether they believe the banks are on their side. Ask Mzekimani if the system works for ordinary people. Ask the communities poisoned by projects funded through bank loans if finance is a neutral force. Banking should be a force for good, a tool that empowers people to build secure futures, weather financial storms, and create generational wealth. Banks have mastered the art of promising ladders while selling chains. And you watching this now, whether you are in Africa, Europe, Asia, or the Americas, ask yourself, is your bank serving you or are you serving it? Despite the grim picture we've painted, there are reasons for hope. Financial technology is breaking down barriers, reaching people traditional banks never could. New regulatory frameworks are emerging, designed with ordinary consumers in mind rather than just bank shareholders. Grassroots financial initiatives, often led by women, are creating alternatives to the traditional banking system. Legal precedents are being set that strengthen consumer rights against financial exploitation. And a new generation of banking leaders is emerging, some with a genuine commitment to ethical finance. The remarkable success of banks like Equity proves that serving ordinary people can be both profitable and transformative. Global movement, financial transparency, and accountability are gaining ground, and technology is enabling new models of finance that could bypass the traditional banking system entirely. The true wealth of Africa has never been in the bank vaults, but in its people. Their resilience, creativity, and a determination to build better futures. The question is not whether the financial system will change, it is whether the change will come from within or be forced from without. The betrayal of African banks is not just an African story, it's a human story about power, control, and the systems we create to manage wealth. Every time money changes hands, it carries with it a story of labor, of sacrifice, of dreams. When you entrust the money to institutions, we are not just making a transaction, we are entering a moral contract. Banking began as a service, a way to safeguard value and extend credit where needed. Somewhere along the way, that purpose was corrupted. The gap between what banks say and what they do has grown into a chasm of betrayal. But it doesn't have to be this way. Finance can be reclaimed as a force for good. Money is not just currency, it's the crystallized form of human potential, and how we bank it determines whether that potential grows or withers. So here's what you can do. Learn your country's digital lending laws. Ask your members of parliament or the lawmakers what expectations exist for borrowers. Support open banking transparency platforms in your region. Because if we don't fight to reform this system, we remain at its mercy. So, I leave you with one question. In a world where money shapes nearly every aspect of our lives, who should control its flow? Those who have the most, or those who need it the most?